We got things to do. Let's do it. First of all, just a continuation of this discussion, and there's two things that we still need to talk about. One, which was a question that was asked, and then the second one is I haven't finished this whole story yet, so there's more to come. The question here was, but hang on a minute, if the South African rand is depreciating so that the US dollar is appreciating, the dollar is appreciating, isn't there then more demand for South African goods and services? Therefore, the supply of dollars should shift as people want more stuff. And it's a good question because it's the question that everyone gets confused. So it's not a shift in supply because it's an increase in imports that comes because of a change in price, which means it's a movement along the supply curve. It is the import effect that you are describing. If the dollar appreciates, what do we see happens? We move along the supply curve. The supply of dollars, the quantity supplied, increases. Why is the quantity of dollars supplied increasing? Because of an import effect. As the dollar appreciates, it's cheaper for US citizens to import South African goods and services, so they import more. And we have an increase in the quantity supplied. The import effect, right? In other words, remember, why is the supply curve upward sloping? Because of an import effect, which is different to shifting the entire supply curve. Okay? In other words, if there's a change in preferences that makes the US citizens want to buy more South African goods and services, regardless of the interest rate, the exchange rate, then we've got a shift in the supply curve. If they're buying more goods and services because the rand is depreciating, then it's a movement along the supply curve, right? The second thing is, we spoke in this story, there was an increase in interest rates in the United States, which led to an increase in demand for dollars, right? But there's another thing that's going to be happening here as well, which we haven't spoken about. All we've done is looked at it really from the South African side. There will be an increase in demand for dollars as South Africans want to buy US financial assets. What about US citizens? They also want to buy their own assets rather than buying our assets. Why would they buy our assets when they can get higher interest rates on their financial assets? So there's another thing that could have happened here, or that is likely to happen. There would be a decrease in the demand for rands. Right? In other words, when the US Fed increases interest rates, what's happened? The South African, let's do this. The South African interest rate differential has decreased. So remember what happens. There's a demand and a supply side effect when interest rates change. So first of all, we've spoken about a supply side effect for rands, right? So the supply curve for rands, the interest rate in South Africa and in other countries relative to one another, it's going to shift the supply of rands and it's going to shift the demand for rands. So that was the demand side effect. And on the supply side, where is my supply side curve? Oh, this is the supply side. Sorry. So on the supply side, the interest rate can shift the supply side curve, and on the demand side, it can shift the demand curve. Okay? So here we've got the interest rate changing the supply of rands, but the interest rate is also going to affect the demand for rands from the other side, from the US side, right? So from the US side, there's a decrease there's a decrease in demand for rands. And I want to just, there we go. So our demand for rands can also decrease, and the supply of dollars within the market can also decrease within the market for dollars. So once again we have the same effect, appreciation of the dollar and depreciation of the rand. Here we've got the change in quantity unchanged, and we're going to have the change in the quantity of dollars unchanged as well, just because that's how I've set it up. But it doesn't have to be like that. Quantity could be up, could be down, it could be anywhere. Okay, so why is there supply of dollars in the market? When we're talking about rands per dollar, we're talking about trading dollars for rands. So why are we supplying dollars? Because we want to buy South African goods and services. We want to buy South African financial assets. Yes? The interest rate differential changes. So even though the South African interest rate didn't change, the dollar interest rate went up. That means the interest rate differential changed. Okay? So interest rates relative to South Africa in the US are now better, which means we're going to want less South African financial assets. So our demand for financial assets on the South African financial assets decreases, and our supply of dollars to buy those decreases. So on the supply side, the quantity effect would be negative on the supply side of the dollar market. And on the demand side of the dollar market, the quantity effect is positive. So what happens to quantity, we don't really know, but there's definitely appreciation of the dollar and depreciation of the rand. Okay? Everyone happy with that supply side discussion? Or not? Yeah. Yes. Yes. That's a movement along a curve, because when we depreciate, it's a change in the price level. It's not a shift in a curve. It's a movement along a curve. Happy with that? Okay. So let's go. Let's look at the black and the red. Black and red. Okay? So don't worry about the blue for now. Here's where we were initially. This was our initial point of equilibrium, point A. Okay? US Fed raises interest rates. Okay? The rand depreciates. Okay? What do we have? A movement along a demand curve. From point A to point B, we're going down our demand curve. As the rand depreciates because of that increase in supply of rands, increase in the supply of rands causes the rand to start depreciating, right? In other words, what happens? Look here. At the initial interest rate, we've got equilibrium A, and there's an increase in supply. The quantity of rands supplied is greater than the quantity of rands demanded. Why? Because now South Africans want to buy US financial instruments, exactly. When the quantity supplied is greater than the quantity demanded, there's downward pressure on prices. As the rand starts depreciating, US goods and services start getting more expensive. So we start demanding less. So we move to the left along that supply curve. We start importing less of their stuff. Remember? Import effect. Okay? As the rand is depreciating, we've got import effect as we move downwards along our supply curve, as those goods and services get more expensive. What's happening on the demand side? As it depreciates, South African goods and services are getting cheaper relative to US goods and services, so the US starts importing more of our stuff. We start exporting more. They start importing more of our stuff. as we export more, there is more demand for rands. So you see the quantity increases, right? The quantity of rands that are traded increases because the rand is depreciated. Okay. Any other questions? Who's with me on this? Okay. Who's not with me on this? As long as no one's not with me, then we can continue on. Soldier forward. Okay. So we can shift demand, shift supply, and then we're going to see changes in the exchange rate. If the demand for South African rand increases and the supply does not change, the exchange rate strengthens. In other words, the currency appreciates. If demand decreases, then the exchange rate weakens, which is to say the currency depreciates, which is what we've seen here. Okay? When the demand for rands shifts to the left, rand depreciates. Okay? So if the demand for rands decreases, the exchange rate weakens, the currency depreciates. And the same for the supply side of the market. So we've seen the demand and the supply side effects of things going down in the market for rands, and we've seen the supply and the demand side effects for things going up in the market for dollars. And we can do this whole exercise by just reversing that as well. What happens if the South African Reserve Bank increases interest rates instead of the US Reserve Bank? Repeat this exercise. Everything will just be in reverse. Same applies for when there's a change in expectations or there's some sort of new information that enters the market. That can shift. A change in expectations could be a change in preferences. Maybe we realize that all meat grown, imagine the world realizes that all meat grown in South Africa, if you eat it, increases your lifespan by 5 years. What do you think is going to happen? Doesn't matter what the exchange rate is, the demand for rands increases, right? So some kind of change in expectations, change in information, change in preferences. These are all things that can shift demand and supply for currencies. And of course, there's also profit by trading that involves any kind of arbitrage. So we haven't spoken yet about arbitrage, but that's what we're going to speak about next. How do we get arbitrage activities? Well, the first example we gave was what happens when the interest rate in one country changes relative to the interest rate in another country. Means you can earn better interest rates in that country relative to the first country. So what happens? People start buying more of those goods, more of those financial assets in the country where the interest rate went up. Interest rate goes up, people start buying those financial assets. When people start buying those financial assets, what happens to the price of those financial assets? The price goes up. And if the price of those financial assets is going up, what's happening to the return on those financial assets? It's coming down again. So what happens to the interest rates? You raise the interest rate over here, increase in demand brings the interest rates differential back down. That's arbitrage, right? When there's a pricing difference in two different locations, then it causes demand and supply to adjust until prices come back, right, to equilibrium, non-arbitrage situation. So, I don't know if we spoke about this example or whatever, but let's say that, well, this will probably happen. We have chicken farms in Gauteng, surprise, surprise, that produce eggs, okay, that people eat. Do you know what has just happened down in the Cape? 70% of the egg-producing chickens down in the Cape have been killed. Bird flu. They've been killed. 70% of the chickens that make eggs in the Cape have been killed. 1,000 jobs have been lost. What do you think is going to happen to the price of eggs in Joburg? Why are they going to increase? Well, because we've got the supply in the Cape decreasing. When the supply in the Cape decreases, what happens to the price of eggs in the Cape? It goes up. So what do people start doing in Joburg? They go, you know what? The price of eggs in Cape is high and the price in Joburg is low. I'm going to buy eggs in Joburg and I'm going to ship them down to Cape Town. What does that do to demand for eggs in Joburg? Increases. What does that do to the price of eggs in Joburg? Increases. And so the price goes up in Cape Town, the price starts coming up in Joburg as well, right? Why? Because you've got an arbitrage opportunity. When the price goes up there, buy low here, sell high there, making money, you know? Okay? So the same thing happens in different countries. You can make money off interest rate differentials and you can make money off price differentials. Right? So suddenly the price of eggs in South Africa goes up. Fantastic. You grow eggs in the Netherlands, you start exporting eggs from the Netherlands to South Africa. What happens to the price of eggs in the Netherlands? Goes up. Right? So we end up with something called interest rate parity. Interest rate parity means that you have equal rates of return in different places. Because if the return is not equal, you have arbitrage opportunities. And you also have purchasing power parity, which means that the value of your money must be able to purchase the same real goods and services, and the same, in other words, the price of eggs must be the same in the Netherlands and in South Africa. If it's not, arbitrage opportunities. Of course, arbitrage is not that simple across countries because you have other costs involved. It costs you to move eggs, right? There are also often taxes and import duties, right? Which means you might have that the price of eggs in South Africa and the price of eggs in the Netherlands is in fact different. But when you investigate, you find that that difference is caused by transport costs and taxes, which means there's no arbitrage opportunity. But if those import costs were eliminated, then you'd find that there would be a change in relative prices as people started arbitraging, making arbitrage profits. Okay? People hustling means the prices are the same. Then there's a discussion about the real exchange rate, and the chapter's not very, doesn't give a very good explanation on the real exchange rate, but basically it's saying, in the same way that we've said that eggs must be the same price in two different locations, right? Which means that your money, okay? It means like this. If it's 10 Rand per dollar, then one egg in South Africa, if it costs 10 Rand, how much should that egg cost in the US? If it's 10 Rand per dollar, it should cost $1 for one egg in the US, right? That means that your money, right, has the same real purchasing power in both places, right? But it also means that the real exchange rate, right, is the same. Now, the real exchange rate is basically, the real exchange rate says, what is the exchange rate, and times the exchange rate by the ratio of prices. So let's say the price in South Africa relative to the price in the US. Okay? So if eggs cost 10 Rand, so let's say eggs, okay? If eggs, the price of an egg in South Africa is 10 Rand, and the price of an egg in the US is $1, okay? Then our exchange rate should be $1 dollar per 10 rand. Or, if I write that differently, the exchange rate should be $0.1 per rand. Are you happy with that? In other words, that's the same as saying 10 rand per dollar. You got that? Which is the same as 10 rand per dollar. If the exchange rate for rands, okay, so this is the exchange rate for rands times the price of something in rands divided by the price in the US. If it's $0.1 per rand times 10 rand per dollar, then our real exchange rate will be 0.1 over 1 times 10 over 1 equals 1. The real exchange rate is 1. In other words, you get 1 egg for 1 egg in the US and South Africa. You could trade in 1 egg for 1 egg. You get what I'm saying? The real exchange rate is 1. Costs the same to buy an egg whether you're in the US or in South Africa. Okay? So if the US economy was only made up of eggs and the South African economy was only made up of eggs and there was no transportation costs and no taxes and no other funny things, then if the price of an egg was 10 rand and the price of the price of an egg in the US was $1, then the exchange rate must be $0.1 per rand, and we'd have a real exchange rate of 1. Everything's exactly equal, right? But the South African economy doesn't just produce eggs, and the US economy doesn't just produce eggs. It produces other stuff, right? And we produce other stuff. So what can happen is if you have the price of goods and services in South Africa generally being greater than the price of goods and services in the US, you might find that the real exchange rate is in fact not 1, because we don't produce exactly the same stuff. What you find is maybe the world wants more of the US's stuff than they want of our stuff, which makes our real exchange rate lower. In other words, it would cost us more rands per dollar if the world in general wants more of the US's stuff. We might find that we have to give up more than 1 egg just to get 1 egg from the US. Do you get what I mean? I might have to give up 1 egg and a carrot to get a US egg. It would be a stupid deal, but it might be the case. In other words, it might be that in the US, it costs you the equivalent of 10 eggs to get an iPad. Whereas if we want an iPad, it might cost us 10 eggs and 5 carrots. You get it? Because the US are the ones that sell the iPads and everyone wants them, and no one wants our eggs and carrots. That's the idea. Okay? So the real exchange rate can move away from 1. But if everyone produced exactly the same stuff, we would expect it to be exactly 1. That's what interest rate parity and purchasing power parity tells us should be the case. So if you look at the real exchange rate between different currencies, if it's not 1, it tells you something about the relative importance of that country relative to the other countries in what people, do they want the goods and services from that kind of country, right? Which the textbook doesn't really give a good explanation of, but that's what it's about. Then we have different kinds of exchange rates. So remember we saw monetary policy. You can have different kinds of monetary policy. You could have inflation targeting, or you could have exchange rate targeting. Remember that? Well, given that you can have exchange rate targeting, you can have exchange rate policies, which forms usually part of your monetary policy. And you can have a flexible exchange rate. You can just let your exchange rate do whatever it wants to do in the markets, or you can try and influence it and have either a fixed exchange rate or something called a crawling peg. Crawling peg means you let it adjust but slowly. You don't just let it go up and down, up and down, up and down. Like when it wants to go up, you kind of stop it going up for a while and then just let it go up slowly. And then if it wants to come down, you let it come down slowly. And in between, if it's going up and down, you're kind of just keeping it stable. Right? That's a crawling peg. So the big manipulator of exchange rates in the global economy is China, and it has. Remember that guy? We watched that video of that guy, Neil Ferguson. It's spelled Niall. He says it's Neil, whatever. So he has a series. It's very cool. It's called The Ascent of Money. He also has a book. Anyway, and the last chapter of that is he calls it. Do you know what a chimera is? So a chimera is like this mythical beast. It's just, sorry, I'm off on a tangent here, but it's kind of clever. So a chimera is spelt like this. Okay, that's a chimera, and a chimera is like a mythical beast, that causes, like a dragon, basically. Okay? So Neil Ferguson, his final chapter is called Chimerica, right? Which is like the combination of China and America. Because the biggest holder of US bonds is China. So China basically owns the US's debt in a sense. Okay, so trade between China and America, it's like, it would be very difficult for those two countries to go to war because they're so interlinked. Trade between the two is, like he says, it's become chimerica. It's this massive big beast. It's like, you can't separate the two without causing massive chaos on a huge scale, like an outrageous scale. Anyway, chimerica is quite a cool idea. Okay, I'm just pressed for a bit of time here. 15 minutes and we're going to do the balance of payments, which is like a really annoying thing, but it's like accounting, but it's not really accounting, which is why it's a bit annoying. So they've got the table here, and I was just looking at the most recent figures, South African figures, and we can take a look at those as well. Okay, here we go. So the balance of payments is basically accounting for a country. Except for those of you that do accounting, there's a very strict set of rules, and the balance of payments only does half of those rules, which is weird. So if you can imagine, change your mindset a little bit. You sell goods. You're a company and you sell some goods. What are the accounting transactions that would happen when you sell those goods? So first of all, understanding that, remember, accounting, when do you debit something? A debit means money going out, and a credit means money coming in. That's what it means. No, always. 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 Okay, let's set up a company, and we're going to just start the balance sheet. Okay, we're going to start a new company. It's going to be called Nick's Awesome Company. And I am going to be the shareholder. So I'm going to input capital. Okay? I'm going to give money to my company. Debit or a credit? Ah, come on. I'm giving money to my company. It's owner's equity. What is it? Owner's equity. What do you do with owner's equity? Credit, because that's money into the company. Now I'm going to open a bank account under my company's name, and I'm going to put the money into that account. Debit, the money goes out of the company into the bank account. So money came into the company from me, credit. It goes out to the company into an account called bank account. It came in through an account called owner's equity. It went out into an account called the bank. Now I want to spend some money. We'll get there, but first I want to spend some money. I'm going to spend some money on an expense. It's called an electricity expense. How do I pay for this? I get money from my bank. Where does my money come in from? My bank account. What do I do to my bank account? I credit my bank account. Where does my money go out to? It's my expense, electricity expense. I debit my electricity expense. That's money going out. Question. Doesn't matter whose perspective. we're looking at it from the perspective of whoever's accounts we are looking at. So I'm looking at it from the perspective of the company. I'm a company and I have a bank account. What do I do when I put money in a bank account? I debit my bank account. That's my money going out of my company into an account called bank account. Okay? Now I want to buy a car. Okay, now I want to buy a car. How do I buy a car? I get money in from my bank account, or I borrow money from someone. Okay, I borrow money. What do I do? Creditors who put money into my company. Then where does it go out to? It goes out to a motor vehicle. I'm spending it. It's going out. It's going somewhere else. Where? Motor vehicle. I debit motor vehicle. Is motor vehicle an expense? No. It's an asset. That's why you debit assets and you debit expenses. Not just because it's a rule. It's because money goes out to assets and expenses. Why do you credit owner's equity? Oh, because that's the rule. No. Money comes in from owner's equity. What about profit and loss? I'll leave that up to you. Okay, anyway, so now that we've done some basic accounting and we understand that there's money in and money out, that's what accounting is about, then we know that if we are a company that is selling something, what do? We're going to sell something. So first of all, we get revenue, for example, or income. We sell something, we're a company. So we open an account called income. What do we do with that account? We credit it. That's where the money came in from. Sales, income, revenue. Credit that account. Let's say that I sold something. In my inventory, it was valued at 500 Rand, but I sold it for 1,000 Rand. Okay? I credit my sales, 1,000 Rand. And so the money came in through sales. Where did it go out to? I stick it in my bank account, a debit bank. Okay? When I sold the thing, what happened though? Inventory. Where did the value that I sold now, so now it's not money directly, but where did the value come from? It came from my inventory. Came in from inventory. I credit my inventory. Where did it go out to? There was a cost. It was cost of sales. I debit my cost of sales. That's where the money went out. Right? It came in from inventory, and then I sold it. It went out of the company. The value came in from inventory. I credited my inventory. It went out through cost of sales. That's where it went. So those are my 4 transactions. Okay? 4 transactions for a sale. Right? There's a lot of things going on there. Balance of payments, throw all of that out the window. It's just like, we only record some of that for some reason. So the first thing we have here is, for example, a current account versus a financial account. Current account is goods and services. Okay? And some other stuff, but it's mostly just goods and services. Financial account, financial assets. Again, there's some other stuff in there, but it's mostly just financial assets. What is the stuff that's in there? Well, there's your discussion of the things that are in there, but those are your main things. You also have this little thing here called a capital transfer account, which is just it's like a funny little thing that comes from, it gives you an explanation there, but it's basically like weird financial transactions that happen that are not from the sale of goods and services or assets. So, for example, if people immigrate into this country, they bring assets with them, right? That goes into something called the capital transfer account. Okay? So it's goods, it's not like sales and stuff. Whereas the current account is about the sales of goods and services, financial account is about the sales of financial assets. The capital transfer account is kind of like assets that get moved around, but not really through sales and things like that. So debt relief is another capital account, capital transfer account. Anyway, so what we have here is merchandise exports, and exports you will see are a plus in our current account. Exports become a plus. So what happens when we export? When we export, we send our goods and services overseas, right? And we get paid with money, okay? And that's a plus. And a plus, remember, in accounting is usually it sits on the credit side normally. Well, again, money in is I consider that a plus, money out is a minus. That's a debit. Okay? That's why they always balance, because there's always a plus for every minus. It goes in somewhere and it goes out somewhere. tracking where these things are going. So anyway, we've got exports as a plus. What that means basically is money in, goods out. But you'll notice that there's no corresponding minus. Like, where's the other transaction here, you know? We've only got 1/2 of a transaction. And that's just the way that the balance of payments works. It only records half of the transaction. It doesn't have a double entry accounting system, which is weird. So what does happen then is, so you have a plus when money comes in. Okay? You with me? Then if you import, when you import there's a minus. That's goods and services coming in, but money going out. Okay? And then if it's negative, you can see we've got a negative over here in our current account. What does that tell you about goods and services going in or out and money coming in or out? It's negative on the current account. We bought more goods and services in than what we sent out, which means more money went out than came in. So that means, in a sense, that we are, if we are importing more goods and services than we're exporting, means that we are basically buying more stuff than what we are selling. It's kind of like we're borrowing from the rest of the world in real terms. You get what I'm saying? Okay. Except that we've also got to match it against our financial assets. Okay? So again, what happens when other foreigners, when there's direct investment in South Africa, in other words, buy our financial assets or our factories, it's kind of like, again, our factories don't leave, but the ownership of our factories leaves, and what comes in? Money, right? So there's a plus. Okay? What happens when we invest outside? So direct investment of South Africans outside of the economy. We buy foreign assets, the ownership of those things comes in, and our money goes out. Now here it's a plus with a star, and the star says a positive means that South Africans have sold some of their foreign assets, right? So we actually had disinvestment, if that makes sense. Okay? But obviously, if it was a negative, it would mean we were buying more foreign assets than what we were selling. The fact that it's positive means that we're selling more than we're buying. Okay, and then we get a positive number here, 77. Okay? And then there's another thing here called unrecorded transactions, which is funny because it refers to unrecorded transactions are referred to as a statistical discrepancy, right? So in the US, for example, or in the UK, or in the developed countries, there will be some kind of small number that's unrecorded. So in other words, if your balance on your current account is, say, 100, and the financial account is, say, 97, then the unrecorded transactions tend to be around like 1 or something like that. That's a statistical discrepancy. When you've got 54 versus 99 and 75, that's 2/3 of the value of everything recorded in your financial account. That's not a statistical discrepancy. That's, we can't record the bloody transactions. We don't know what's going on, right? That's like, there's so many things happening that we just don't even know about, right? That's unrecorded transactions. That is not a statistical discrepancy. It's funny that they call it one. Anyway, if we look at the South African economy currently, which is just what I was doing, so here's the latest financial accounts. So you'll see for 2016, okay? 2016, what was the balance on our current account? Negative. Does that mean we're importing or exporting more goods and services? We are importing more goods and services. Okay? And then you see this capital transfer is some tiny little amount, which is just, like we say, debt relief and, assets not being traded. Then if you look at the balance on the financial account, don't look at this number here, look at this number here. It's 190. Okay? So in 2011 is the figures that they've got there. Negative 60. They claim to have the numbers for 2011, but they don't. Because they've got it as negative 99, which it's not. It's negative 66. Anyway, so the numbers that they got here are not the right numbers anyway. So here we've got negative 142-ish. And then including this, we get negative 141,355. So that was our current account balance. Then we have a balance on the financial account, okay, which said 190 basically. So if it's 190 on the financial account, did we sell? Is that money in or out? First of all, is one way of looking at it. That would be, okay, which means we sold more financial assets. Okay. Then there's this thing here called reserves, negative 40, which balances this out. In other words, you take negative imports here. Okay, so this was we imported more than we sold, goods and services, plus this is reserves, increased our reserves, okay, in order to get foreign assets. Okay, what does this mean? In other words, we got more money coming in, and here, notice that, how do I put this? Yeah, I'm not an accounting teacher, so run with me here. Okay, if we lend to the world, right. So the final part of this chapter is a discussion on the balance of payments, right? What it is that goes into those different accounts, okay? And when you call a nation a debtor nation or a creditor nation, and that's basically based on different values in these different accounts.